following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Well, we're back to NinjaTrader Live. Good morning. I'll be your host for this segment, Technical Analysis Explained. Tom Schneider, CMT with NinjaTrader. And I hope you got to see the previous segment with Jim Cagnina and Stephen Jonathan. Always a lot of information coming from Stephen. Great person to work with. I've worked with him for many years, previous employment. Great guy as well. So if you didn't get to see it, you can always look at the replay on the Learn page or in YouTube. So today's topic, we've done this topic before. We're taking a slightly different tack on it. We've had the topic of moving average as a study, and moving averages are interesting because, well, first of all, when you look at a chart, more often than not, you will see a moving average on that chart if you're looking at somebody who's analyzing the markets. You turn on the TV, business type TV like Bloomberg or CNBC, and you'll see charts with moving averages. And certainly we know there are some preferred periods of moving averages, but you can with the software we have today, you can make them your own. So it's a great thing. Today we're going to take a little bit more of a exploration in not just one moving average, but multiple moving averages, and some of the differences that they may, or some of the different reasons they might be used. But before we do that, I do want to review what a moving average is and why we use that. So maybe Mission Control, if we could go to the charts, great. Here's a plain old, and I say plain old, this is about as vanilla as it gets. E-mini S&P, one of the most traded contracts in the CME. Not the most traded, but one of the most traded in terms of volume is the E-mini S&P, represents pretty much the overall market, and on a daily chart. I've got these bars up. I don't have candlesticks up, although you could put moving averages on a candlestick chart, and we do. It just, with the colors, it might be a little more distracting. So there are different types of moving averages. We're going to use a simple moving average for the purposes of this part of the segment. The simple moving average is about the most basic moving average you can have. And if we double click on this, I'm going to change this from the default of 14 to 50. And just, you can see right there, when I went from a shorter time frame to a longer time frame, we had an adjustment of the way the moving average works. But what we're doing is when we're calculating a moving average, we start with, let's say, the current bar, okay? So the current bar has 4 values, open, high, low, close. We'll focus on the closes, and it also has a moving average value. And I can bring up my mouse, and I can click on the mouse button. I don't left click, I click on the mouse wheel, and it'll bring up my data window, my heads up display, some people call this. And you'll notice it has open, high, low, close values as well as volume, has the date. It has, in this case, it has, what is that? Is that the week, the 15th week? Yeah, maybe we're in the 15th week of the year. So really interesting there. But at the bottom, it says SMA. Now that S is for simple moving average, SMA, simple moving average, and it has a value as well. And so how do we determine what those values are, the simple moving average? Well, we're taking a 50-period moving average. We're taking a calculation of the last 50 bars close values. So let me see if I can bring up the annotations, because that is where I can maybe draw something here and you can see what it is. We'll see if I can do that. Just bear with me one moment. Things move around, and so sometimes things are not where I find them, but I'll try to point them out here. Let's see. No, we'll just use this. Um, let's see if we can do this. Wrong way. Here we go. We'll try this. So each close, you can see each close right here. 1, 2, 3. If we did this 50 times, we'd have 50 closes, but they're the 50 most recent closes. And if we added those all up and took an average divided by 50, we would get this value. And I can know that because that's how it's calculated, right? That's the current value. Why is it moving? Well, every bar, there's a new calculation. So yesterday's calculation did not know about this close, of course, but it also included one more close that wasn't calculated today. It's the 50th bar from this bar. It isn't used in today's calculation, but it's used in this calculation. So as the chart moves along, we drop the farthest data point from the current bar and include the current bar. So that's a moving average. The values calculated are always moving. And so what that does is that smooths out the trend. So that takes away these little nuances where even in an uptrend, we have a pullback. Even in a downtrend, we might have a little bit of a rally. This smooths that out. We don't see those very smaller, minute details. 50 period moving average. What does that mean to us? Well, it gives us trend ideas. It gives us an idea of where the trend is heading. And you can see, let me get rid of this annotation. That's from before. We have ups and downs, and within those ups and downs, we have smaller ups and downs. That wave-like behavior is kind of smoothed out by the moving average. The moving average really doesn't pay attention to these moves up, these moves down. They're calculated. They're part of the calculation. But if you calculate 50 different values, it's really going to kind of smooth it out. As opposed to the 14, which is the default, or maybe 200 will smooth it out even more. And it could be a very different value, of course, because we have different values calculating the study. Now, what else can we use moving averages for? In addition to just seeing where the trend is, a lot of times we use those as guidance for where the market might find support and resistance. So recently, this is a great example. I didn't even know it until I changed it to the 50. The E-mini is finding support at the 50-day moving average. And if we drill down a little bit, I'm going to zoom in. You can see what happened Wednesday. We traded and we do the comparison. We were just about 5 handles off of the moving average. We were just above it. And if we go to yesterday, we traded below it. The low was at 173.50 and the moving average is 177. So about 4 handles the other side. And here we traded below, but now we're just above. So this moving average acting as support. And the question is, will this market turn around and that support be found, or will it close through the moving average? That would be kind of the second step in the weakening of the support level. First step is trading through it. Second step is closing through it. And then maybe having an entire candle below it would be maybe the third strike against it as support. And maybe we're seeing a change in trend in whether the moving average acts as support or resistance. It goes from support to resistance. That could be maybe confirming a turnaround. So support, in addition to trend, what is the trend? Are we above the trend? Are we below the trend? That's another thing we look for. But support and resistance certainly is key to why we use moving averages. I mentioned above and below. It's just a quick check, right? If the market is trading above a moving average, it's considered bullish, right? Now, it doesn't always mean that, right? We could trade above and then quickly come below. We could trade above and quickly come below. So we want to see these things where, yeah, we close above, we tick above, we close above, we trade above, and even then that might not be enough and it turns around. So, but you'll notice that, the moving average doesn't change as quickly as the trend. So, sometimes it's good to look at the moving average to see, well, okay, we're below it, but maybe we can get back up to it. And again, that's where the support and resistance comes into play, right? When that happens, we want to see, is it acting as support or resistance here? Does it become support? Is it acting as support here? It becomes resistant here, or hold as support? We'll see. Now, multiple moving averages. Why would we use multiple moving averages? Well, when we look at the number of calculations that we use to calculate a moving average, the number of bars, the number of data points, we can use them for different purposes, right? We can have a shorter term, like a 20 period moving average. And very simply, I would just add another indicator and we'll just grab that SMA and we'll add it again. Now here's where I want to change a couple things. One is, let's say 20, we'll make it a 20. And we'll say, you know what, I want to see each price change. Now, what's the difference between tick and price change? You could have multiple ticks at the same level, multiple trades at the same price, right? Each tick is each trade essentially. On price change, I only really need to know on price change for a moving average because volume doesn't really matter to moving averages. I don't care if it's one contract or 100 contracts trading at this price. It doesn't affect the moving average value. But if the price does tick up or down, then I want to know about that because my moving average value will change. So I want to say on price change. What that does for you is it doesn't tax your PC processor as much. Now, this is probably going back, showing my age when it mattered. But if you have these high volume markets and it gets into a news moving market moving event, then yeah, maybe there is some delay avoidance you have by putting it on a price change versus tick. But that really is kind of a thing of the past. But we still don't want to tax our processor if we can help it. We want to avoid that. Now, I generally change the color as well. The smaller I go, and this is something I learned from Jim, it's kind of easier to think about. The redder I will go. So I'll put red, something very close, and I'll make it a little bit thicker so we can see it. You can make it a dash line, a dash dot. You can change all sorts of things. But this is my 20 period, and I could double check just by double click here right up the top. And this is something that if I'm looking for a shorter time period on my trading or investing, then I would want to have a shorter time period. But what also does it tell us? It can tell us a couple things. One is uh, it's kind of like multiple layers of alarms, right? If I'm following the 20 period moving average and I'm expecting support and resistance, well, it's going to get tested more than the 50, odds are, because it just has that closer to the price feel about it. You'll notice that this 50 is a little smoother. This 20 is a little curvier, right? It does respond to price changes a little quicker than the longer term. What that means is we might see more intersections with price. We might see more tests of support or resistance, support, resistance. Here's support that held. Here's support that kind of held. It failed a little bit, came back up, failed a little bit. But you could say that the 20 does a better job of acting as support and resistance, maybe because it's tested more, right? But when it fails, then I want to know, well, if it fails the 20, what's going to happen with the 50? So on the shorter term, this catches a change in maybe trend a little bit better. Look, if we're up above the 20, we're bullish, right? If we're above a moving average, we're bullish. That's probably going to fail. If we see a turnaround, it's probably going to fail the 20 before it hits the 50 because they are trending laggy instruments. So why do I have multiple moving average on them? Isn't there one perfect moving average? Well, nothing's perfect. Nothing's perfect for everything you're trying to do as a trader. You might want to know about the longer term trend. You might want to know about a shorter term trend within that longer term trend. You could go super long and see some great support or resistance levels, but they might not matter as much because, well, they don't happen as often. And we could see that, right? We can add another, let's add the 200, right? We hear about different moving average levels on TV. It seems like 50 and 200 seem to be the case that the financial news like to use. And certainly I saw that in the institutions use that quite a bit. So we're going to use this on price change. I'm going to get rid of this. Well, we can keep the label up there. That's fine. I'm going to change the color just so we have a little bit of a distinction. And I want to make it something you all can see. So I'm going to make it green. We'll make it dashed as well. We'll make it a little bigger so we can see it. And we can even make it a little bigger. There we go. So here we have the 200. Notice it's really, really flat. And I don't mean flat horizontal, but it's kind of this constant increase, right? The market we know has been up. It's been up since what? Beginning of 2023 or maybe end of 2022. I think that was it. October was the low, right? And this moving average was in a downtrend of pretty much most of 2022. So it was sloping down. And it took quite a bit for this slope to change to the positive, well after the October lows, because it's using 200 days worth of calculation. That's 200 days of trading days, not calendar days. So we're talking about 10 months worth of data before it changes. So long-term trend, we didn't even find support when it came down in October. That just shows you, you look at this, wow, that's okay. That's a little bit of a pullback. It's a pretty big pullback when that 200-day doesn't support it that much. And you can see there's a lot of distance between the 50 and the 200 versus the 20 and the 50. And that makes sense because these are closer. So, you might see, I don't know, 50 and 200. You might see 20 and 50, 20 and 50 and 100, all these different values. You also might see Fibonacci values as moving average numbers. Might see 21. 21 is a great number. Not only is it a Fibonacci number, but that's generally, I think, 10 or 9 or 10 months out of the year. That's how many trading days there are in that month. So it's truly like a 1 month number for most of the months. 21, 34, 55. These are all Fibonacci numbers, and I've seen them on charts as well. So what are we doing? What are we doing with this? In addition to support and resistance, can it help us identify potential reversal points? Of course it can. Of course it can. Now, are they going to be points? Are they going to be peaks and valleys? When I say reversal points, I mean for your thinking, not necessarily for the market. Moving averages are laggy by nature, so they're not going to anticipate a trend change. They might confirm a trend change, which can be a good thing if you're trading. I'm going to modify this again. I'm going to go to my indicators. I'm going to remove that 200. I'm not going to remove it. I'll just make it invisible, and we'll hit apply and hit OK. And so what are we looking for? Well, when we talk about moving averages crossing, when they intersect, what is that telling us? That's telling us that possibly there is a trend change that has happened and we should pay attention. So let's look at this. I'm going to use my NinjaTrader annotations, and you'll forgive the colors because it's generally red indicates a bearish thing, but this is actually a bullish cross. When the shorter moving average, what I mean by shorter is the one that uses the least amount or the lesser amount of calculations, in this case a 20 period, crosses a longer period, we pay attention to the direction of the cross, because that smaller moving average period is closer to price. It's going to change. It's going to react to price changes faster than the longer one. So in this case, a 20 period moving average crosses above a 50. That's considered a bullish indication. Now, on the chart, it's very deceptive, because on the chart, the values at which they cross are most likely going to be away from the price. When I look at this, we're not evaluating this as if we had bought down here or sold down here. No, we have to look at where the price is. But what it's saying is, okay, we've been in an uptrend for almost a month. But this is confirming that, yeah, maybe this trend is going to continue. This trend is real. This is a reversal. Now you have other ways of doing that, right? I see three peak highs that got lower, and then we took out that first peak high. And that happened before we got this cross. That might be an indication. We also use moving averages for the crossing purposes where the price crosses the moving averages. Those can be those can be indications as well, but they can also be whipsaws. Sometimes we see price cross around a moving average. And so this gives me a little more faith that this trend is a good bullish trend. If I look at that, let me see if I can point it out where we would have maybe taken the signal. Now you don't have to trade this, but some people wait for confirmation, right? And it's that idea we talked about with Larry Williams a couple weeks ago is buying it at a new high, right? Buying a breakout of an existing high of sorts because it's on strength. So the idea here is not too dissimilar. We're not using previous highs as our guides, but we're saying, look, we're already in an uptrend. We missed the peak, but that's not the point of this. We want to know when this uptrend is in play. This uptrend, is it legit? Well, the trend is up on the 20. The trend on the 50 is starting to turn up. We've got this cross. Maybe this bull trend is legitimate. Now, there was follow through. We know this. We know this, with some hindsight. But if we anticipate crosses, then we should be maybe a little concerned that this 20 is starting to turn down and this 50 might be slowing up, but it's still upward sloping. Well, if we have those conditions kind of heading in those tracks, we might get a turn down here. And this is after that peak. So that moving average turning down while this moving average is kind of staying the course or maybe not turning down as fast, that you might start to anticipate a little bit of weakness in this market. And I'm using a daily on the E-mini S&P. The same concepts stand for any other market and any other time frame. So if I look at a 1-minute chart on corn, or if I look at a weekly chart on crude oil, the concepts are the same. Now, the periods might be different. You might find more relevant periods based on the market and based on the time frame. But the concepts are still the same. The shorter moving average will follow price closer than the longer moving average, and so we should pay attention when it changes position, changes which one is on top. Is the 20 dominant or is the 50 dominant? Is the 50 dominant over the 100 or not? When that shorter one is above the longer one, then we're said to be bullish, and vice versa. So important to look at. But just remember, just because we cross here when this happens, we have to look at price up here and say, that might have been an interesting trade. Well, look what happened. We crossed above and we went sideways for so long. I can understand if you're a swing trader holding that for multiple days. That's not in your DNA. That's not a swing trader, right? That's more of a longer term position trader. But that moving average eventually caught up with price because it went sideways so long, and then the market got a boost. So didn't mean that this was a reversal. What it meant was, yeah, this trend is in play, but it took a little bit before it got its next win. Let's take a look at, let me see what this tab is for. So no, that's a tab we don't need to use. There is a gentleman, David, and I forget David's last name. Maybe it's Guppy. There's something called Guppy Trading, and he really took it to, made it his own. And I'm not going to even attempt to replicate what he does, but I will try to explain. We do have a tool called, let me bring this up. You can find it here. Go to indicators, and this is called moving average ribbon. So this is a really interesting concept. And when you bring it up, it has these colors. You could certainly change the colors and Bear with me one moment. So I'm going to change the value to calculate on price change, same concept. But this ribbon is really different moving averages. It's just a bunch of different moving averages. And they're different in the sense that they are different periods. So they could be exponential. If I change it to simple, it looks much different. Now, an exponential moving average, we'll come back to that. Exponential puts more weight on the most recent data. So it's more adaptive, especially when you look at like a 50 or 200 days ago. I don't even know what was happening. I'd have to go back and say, oh, yeah, the Fed was raising or cutting or holding, or this was the price of oil, which might have affected this market. You know, lots changed since those 200 days. So an exponential puts more weight on the recent data because, well, the news is fresher, right? We're reacting maybe to new situations. So exponential is sometimes the preferred way for some people. Now, what this moving average ribbon does, it says, okay, let's take a base period. The base period in this case is a 10-period moving average. And then each successive ribbon is going to be, we're going to add 10 data points to that. So the second ribbon will be 20-period moving average. The third will be a 30, fourth will be a 40, etc. You can change this. You can make this a 5-period. And when we apply that, you'll notice the ribbon gets tighter. The moving averages get closer. Might be a little too much. But I think one of the basic tenets here is when these moving averages, and again, I'll get rid of that, when these moving averages are examined, we look at them for support and resistance. So for example, the 10 period right here in red, tried to change up the color a little bit so we could see it. The red moving average here is the closest moving average of price. It's a 10-period moving average. So when we're in a trend, it should act as support. Now, if it doesn't, if the market doesn't follow along with that moving average, and it breaks down, in this case, where is the 20? It should go to the 20. And if the 20 breaks, where does it go? It goes to the 30. So the question is, where are my levels if these markets break? And do they hold? If they don't hold, then I go to the next level. When it does hold, then I would expect a reversion back to those closer moving averages. Because, if we think about it, these moving averages, when there's a big break away, it's because there's a change in the data set, whether it's a big move on the current data or a big move that falls off, there's a change. So these moving averages will have different widths. The widths between them will be different just because of the number of calculations. And you can see sometimes the 10 is on the bottom, sometimes the 10 is on the top, and eventually they all switch over. So multiple moving averages, this really to me is, think of it like a net, right? Or you see in the movies or the cartoons, right? Somebody's being held up by something, or they're in a hammock, and then you see one by one the strings break. Eventually everything falls. It's kind of the same thing here. We plunge down below the 10, we're going to find support at the 20. Oh, wait, it didn't find support. We went to oh no, not the 30, the 40. Here comes the 50, right? And as these things finally weaken, maybe that's like, okay, if we get through all of these, that's a really dire signal. Just like on the upside, right? As we go through the 10 to the 20 to the 30, all the way through, we finally have a breakout. So I've run up against time. I could probably talk a little bit more about moving averages for quite a while, but I think it's a good start to think about how multiple moving averages can help you with your trading. And again, everything we did here on a daily, we can do on our intraday charts, we can do on any market.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.